When you retire, there will be periods when your different sources of income will either start, stop, or get reduced. The fluctuations in timing of your income can potentially cause temporary or permanent income gaps. In this video, we'll review 5 situations that might cause an income gap during your retirement. We'll also highlight some of the key ways to close those gaps. But before we dive into the details, welcome to the Money Briefing. My name is Derail and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. The federal employees' retirement system is designed to provide stable income through a triple-layered approach that includes your pension, Social Security benefit, and Thrift Savings Plan. However, there are controllable as well as uncontrollable circumstances that can cause breaks in the stability of your retirement income. These breaks can also be described as income gaps. By definition, an income gap is the difference between your actual income and your actual expenses. During retirement, there are 5 critical junctures that could cause you to encounter an income gap. The first one is the separation income gap. This occurs immediately after you retire or separate from federal service. While your application is being processed, there's going to be a waiting period until you start receiving monthly payments from OPM. You'll initially receive interim payments. There's no exact timeline or formula to determine when and how much you will receive for your interim pay. However, you will generally receive your first interim check about 6 to 10 weeks after you retire, and your interim payments will be about 60 to 80% of your expected net pension. As of June 2024, most retirees will receive their first full pension payment within 3 to 5 months of retiring, but you should keep in mind that these estimates are subject to change based on the backlog of retirement applications and the number of new submissions that OPM receives. Your application could also get delayed if there's any special circumstances or any missing or incomplete documents. On a positive note, when you finally get your first full check, you'll also receive the difference between your interim payments and the full amount that you should have been paid. During the waiting period until your interim and full pension payments start, it's important to have cash reserves to help cover your living expenses. If you have any unused annual leave, it can also help offset the income gap during this period because your accrued annual leave will be paid out as a lump sum, usually within the first month after retirement. New retirees should also be prepared to adjust from biweekly checks to monthly checks, which may require some budget adjustments in the beginning. The second gap is the supplement income gap. The FERS supplement is designed to help bridge the income period between the start of retirement and until you become eligible to draw Social Security at age 62. About half of federal employees are entitled to the FERS supplement when they retire. If you qualify for the supplement, it will be included in your monthly check when you start receiving your full pension amount. However, the supplement will provide significantly less income than most retirees age 62 Social Security benefit unless they have at least 40 years of civilian service. For instance, if you have 30 years of service, your supplement will be approximately 75% of your age 62 Social Security benefit. And if you have 20 years of service, your supplement will be about 50% of your Social Security benefit. That difference can create a major shortfall and income gap. Additionally, the FERS supplement is not increased by any cost of living adjustment. So for regular FERS retirees, whatever your supplement income is when it starts, it will be that same amount until the supplement ends at age 62. The supplement is also subject to an annual earnings limit, which may affect the payment amount from year to year. Exceeding the earnings limit may severely reduce or even eliminate your FERS supplement. The next critical gap is the Social Security income gap. You have the option to start Social Security at any age between 62 and 70. There are advantages and disadvantages of claiming your Social Security early. The obvious advantage is the sooner you claim your benefit, the earlier you get some form of income. However, Social Security payments are reduced if you claim them before your full retirement age, which is between 66 and 67, depending on your birth year. Therefore, if you sign up at age 62, your Social Security payments will be reduced by 25 to 30%. Similar to the FERS supplement, Social Security is subject to an earnest test if you started before your full retirement age. On the flip side, there are incentives for those who are willing to wait. Your monthly payment will get larger for each month you delay claiming your benefit. You'll get about a 6% to 8% boost to your payment for every year that you delay. But as you wait, you have to fill that gap with some other source of income. The fourth gap is the savings income gap. Your savings may include your TSP, your IRA accounts, and any other liquid assets that can be used to fund your living expenses. Typically, your savings will fill any gap that is not fulfilled between your pension, Social Security, and other fixed income. However, you must be careful because drawing down your savings too much or too quickly may create a different dilemma. There are a few standard strategies for withdrawing money from your investment accounts, but it's best to establish a withdrawal plan that fits your personal income needs. Additionally, future market conditions and inflation can have a big impact on determining how long your savings can stretch in retirement. Those who have sufficient sources of income may choose to delay withdrawing from their retirement accounts until they're forced to take required minimum distributions or RMDs. If you have the flexibility to go without that option or to go with that option, you still want to do some planning to ensure that your future withdrawals don't create any unexpected challenges down the road with taxes or Medicare Part B premiums, which are based on your income level. The last gap is the surviving spouse income gap. If you're married, your spouse is eligible to receive a portion of your pension benefit after you die. Under FERS, the maximum survivor benefit is 50% of your annual pension. Leaving your spouse with the maximum benefit of 50% will reduce your monthly pension payment by 10%, and a partial benefit of 25% will lower your monthly payment by 5%. If you choose not to leave a survivor benefit, there's no reduction to your monthly pension payment, but this could cause a sizable income gap for your spouse after your passing. It's also important to mention that not leaving a survivor benefit could have other consequences as well. It might affect your spouse's eligibility to continue federal health insurance coverage after you die. Given the rise in healthcare costs as people age, this could have a large impact on a person's cash flow in retirement. Life insurance can definitely help close an income gap left after one's death. But keep in mind, most retirees' basic federal life insurance coverage begins to significantly reduce at age 65. So private life insurance and other assets may be required to adequately meet your spouse's income needs. During your retirement planning, if you determine that you may have an income gap at some point in retirement, it's best to be proactive in reducing or eliminating that potential gap prior to retirement. So let's now slightly pivot and focus on some common ways to close an income gap. One way is to increase savings. This can be done by increasing your TSP and IRA regular or catch-up contributions. Another way to grow your savings and investments is to reallocate assets. You may consider investing more aggressively to yield higher growth or to offset taxes and inflation. A third option to help close the income gap is to reduce spending. This can be done by cutting back on some of your discretionary and lifestyle expenses. And don't be too ashamed to save a few bucks by taking advantage of those senior discounts. Additionally, a somewhat similar strategy to reducing spending is reducing your costs. The primary difference between the two is that reducing your costs mainly deals with your mandatory expenses versus your discretionary expenses. Your mandatory expenses are things related to your housing, transportation, medical needs, and debt. One of the biggest ways that people lower their costs in retirement is by downsizing their home. And lastly, to help close an income gap, you can delay retirement. Working longer can potentially increase your pension, Social Security benefit, and retirement savings. There's no question that proper income planning is required to successfully navigate all stages of retirement and to avoid potential income gaps. No matter if you're approaching retirement or already in retirement, it's important to have a plan to overcome potential income gaps caused by a separation from service, smaller supplement payments, Social Security, inadequate savings, and survivor benefits. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please visit our website at www.fedwayfinancial.com, or you can schedule a free consultation by clicking on the meeting link in the video description. Thank you for watching, and we'll see you on the next Money Briefing.